My name is Joe Park, and I'm CEO of Horizon Stewardship. I'm going to welcome you today to our webinar, What's New with PPP Loans? Joining me today is a familiar face, Ted Batson. He's a partner and lead legal counsel as well at Cape and Krause Accounting. Cape and Krause is one of the largest accounting firms who deal exclusively with churches and nonprofit organizations. So we're delighted to have them back. As we move along, I want to let you know that Giving 365 is Horizon's free online resource library. It is filled with webinars, ebooks, videos, podcasts, articles, blogs, and PPP resources that are related to building cultures of generosity in churches and faith-based nonprofit organizations. You are welcome to any of the information that is in there to use in your church. I want to specifically point out that this particular webinar is focused on what's new with PPP loan resources. It is not intended to be an A to Z coverage of the PPP loans. There actually is going to be a seminar like that or a webinar like that Ted is leading on February the 17th. We'll get you that information if you want to do it, but that's about a 90-minute, buckle yourself in and go through each of the fine points. Today, we're highlighting what's new and what's most important for you to be aware of as you think about either a first or a second PPP loan draw. If you're looking for a quick summary, in Giving 365, specifically where you see the new PPP loan resources, there are two articles by Cape and Krause that give actually written by Stan, and they give a really good overview of the PPP Act, the previous one, the new one, and give those finer details that you're going to want to familiarize yourself with if you have not already done that. Well, Ted, tell us a little bit about your connection to PPP loans in your work at Cape and Krause.
So, Joe, in my role as the professional practice leader of our tax practice, I can recall on March 27th, 2020, that's the day the CARES Act became law, about 10 o'clock that evening, I said to myself, we're going to have people pounding the doors on Monday wanting to know about this. So I sat down and wrote the first article at 10 p.m. on that night, got started on it, and we got it published that next week. And it's been nothing but a nonstop journey since then. We had a little bit of a lull in the fall as the loan process itself wound down for the first round of lending. And then it kind of picked up again as people began to file their forgiveness applications. So we as a firm have been at the forefront of trying to help churches and other nonprofit organizations navigate these waters. And I have done a lot of consultations with clients on this topic and done numerous webinars on this topic.
If somebody hasn't been familiar with the PPP loan process, which is administered through the Small Business Administration, you may be surprised to learn that the way this works is Congress wrote the act, and then the SBA was placed in charge of laying out the guidelines. And the way it's worked is that the SBA continues to drop new guidance weekly, sometimes daily, as tax advisors and people present questions to them. And so the truth has shifted. I know Horizons applied for a first round of PPP loans, and we ended up turning in 4 different applications to our lender because the SBA kept making changes. And we actually today learned that first loan had been forgiven. So all of this time had gone on, and we actually applied for forgiveness in mid-July. And in the same way, we filled out multiple applications to comply with changes that the SBA has made. So this is a little bit of a moving target, but so far, most folks have been able to navigate it successfully. Anything you want to add on that, Ted?
I think the one thing I would add is that the Small Business Administration was well equipped to administer this program for businesses. They were not well equipped to administer this program for nonprofit organizations and religious nonprofits, even more particularly, because in their regulations, in their normal everyday small business lending portfolio of business, they have they have rules that prohibit them from engaging with nonprofits, and even more specifically with religious nonprofits. And so Congress specifically called out nonprofits as being eligible for these loans. So the SBA had to figure out which of our regulations are we going to have to set aside because nonprofits are specifically allowed. And then on top of that, Congress had to come along and cajole them into setting aside the non-religious. They weren't really anti-religious. They were just basically saying, that's not who we are. We're not an organization designed to serve the religious nonprofit community. And so we have these curves in place to help set the boundary lines. And now the boundary lines have shifted. And now we have to adjust to accommodate that shifting. So it has in particular been a journey for them. And as we deal with some of the questions that I've already observed have been submitted, we're going to find, frustratingly enough, that we still don't have answers to some of these questions because they're outside their everyday experience at the SBA.
Let's jump right in. You've identified 11 things that you wanted to concentrate on today. Do you want to give us a little context about this before we begin to roll through them?
Sure. So as Joe already explained, this is not a primer on PPP loans and forgiveness. We're trying to elevate out some very specific things to be mindful of as we enter 2021. And we have the whole new opportunity for organizations that already received a PPP loan to apply for a second loan. There's some nuances to that we're going to try and unpack a little bit. There are some things we've learned about from the Consolidated Appropriations Act that was passed in late December. There are some things that affect even loans that were made last year and the forgiveness of those loans that we're going to highlight. So I wanted to make this be a presentation where we focus on kind of the things that have most recently changed and not be as you said earlier, it's not an A to Z discussion of PPP loans, but rather just here are 11 things. That also helps us deal with the time constraint we have today, as well as give us some time, hopefully, to get to some of the Q&A.
All right, well, let's jump in at number 11. I feel like Dave Letterman here. There are now effectively 2 PPP loan programs. Ted, unpack that.
The Act now creates what are called first draw PPP loans. And that is really going to be everybody who got a loan in 2020. If you were one of the first people in line back in April of 2020, or if you kind of came later in the process in June and July and applied for a loan, those are first draw PPP loans. Or if you didn't get a loan back then and you've never applied for a loan and you're applying today for your very first PPP loan, you're still considered to be making a first draw PPP loan. But if you got one of those loans, and typically this is going to involve someone who got a loan last year in 2020, and you've already kind of burned through those funds and you're now ready to ask for a second loan, you're now entering the second draw PPP loan program. And the qualifications for these two have some different eligibility requirements. They have some different limits that we're going to talk about as we go through here today. But there's also similarities. So for example, you are required to use the funds for the exact same purposes. And we'll talk a little bit about that today. And the forgiveness process, the expenses you can claim for forgiveness, and then the process itself for requesting forgiveness are pretty much identical for both programs. So they have some points of divergence in terms of eligibility and the size and shape and scope of each of these two programs. And then they have some similarities as well. And the opportunity to apply for either a first-time PPP loan, a first draw loan, if you've never applied for one before, or a second draw loan is open to March 31st of this year.
Number 10, second draw PPP loans are only available to prior recipients of first draw PPP loans. What if I didn't make a first draw?
So if you didn't make one, then you're going to be making a first draw now. So your current loan would be a first draw loan. And when we get to one of the next points, we'll actually talk about people who are today applying for their first draw loan. Now, one of the questions I've already seen come through the list that says, do we already have to have forgiveness for our first draw loan to get a second draw PPP loan? And the answer to that is you don't have to get forgiveness, but you do have to have used the money already, or you have to be able to demonstrate that you will have used the money already by the time you get your disbursement of your second draw loan. So you don't actually have to have forgiveness, but you would need to be able to demonstrate that you've either used the money, or at least by the time your application is processed for a second draw loan, you will have used the money, and then be in a position to request forgiveness. So in theory, you could be submitting both forgiveness applications at the same time on that basis. Now, the second draw loans, the headcount threshold, instead of being 500 as it was last year, it's now 300 for those. And remember, this is not, there's no full-time equivalency calculation here. This is all based on, I call it counting noses. So we're going to see how many people we have out there by counting noses. And this applies to both part-time and full-time employees. Now, for our audience today, I'm guessing that many of them, this 300 employee threshold is not going to be different. It's not going to be different. They're mostly going to be focused on the gross receipts reduction test. And this is one of those cases where we got a little bit of help in the Consolidated Appropriations Act in terms of defining gross receipts, but there are still a lot of unanswered questions. And I have submitted some of those questions to the AICPA, the American Institute of Certified Public Accountants. And they have a liaison officer who is liaisoning with the SBA regulators who are writing the regulations. And I've been submitting some of these things through her to them. They're getting some play in terms of discussion, but we're not seeing much in terms of formal guidance being issued yet. And I'm not sure if and when that will ever come. Again, this SBA being a little bit of the round hole that we're trying to fit square pegs through in this process. But specifically, they've said gross receipts means the same thing it means in Internal Revenue Code section 6033. Well, what does that mean? First off, note that this is the section that requires nonprofit organizations other than churches and church affiliated schools and some other similar church associated or affiliated entities. This is the provision that requires them to file an IRS Form 990. And so because that form is interested in gross receipts of nonprofit organizations, it lays out a definition. If you really wanted to kind of nail this down, I would suggest that you go look at a Form 990. You can open that up in Google and do a search for it and find it on the IRS's website. And if you look at Part 8, you'll see the revenue section, a statement of revenue section. And it goes through and says, we'll start with line 12, that's the bottom line total, and go back and add things like cost of goods sold if you have them, or cost basis of assets that you sold, or rental expenses from rental activities that you have, or fundraising expenses if you have those. And you basically gross up your bottom line revenue. Now, several people have already asked questions about, well, we're in the middle of a building campaign and we're getting all these restricted contributions to the building campaign that we can't use for payroll, or we can't use for some of these other expenses. Do we get any break on that? Do we get any relief from the fact that we may not have a revenue reduction overall when we have to include those capital funds, but maybe we've had a revenue reduction if we could exclude those capital funds? And that question has been raised. It has not yet been answered. Let me say this slightly differently. I did get an answer that did not make any sense. That demonstrated that the people involved didn't understand the question, or didn't understand nonprofit accounting, might even be another way to say that. So we're still waiting to get an answer to that. And for those of you who find yourself in this predicament where you have restricted funds, whether they're for a capital campaign or for some other restricted purpose, at present, we don't have a good answer for you. And my apologies for that, but it's outside my control. I can't remember if I had maybe one more slide. Yes, did have one more. So for second draw PPP loans, they are limited to $2 million. So the limit for the first draw loans was $10 million. The limit for these is $2 million. It's calculated as 2.5 times your average monthly payroll, which was the exact same calculation we did for first draw loans. In fact, the regulations state that if you go back to the same lender and you've already given them all the details to figure out what your 2019 average monthly payroll is, that you're not required to submit new information. But of course, you have to be using the same lender for that rule to apply. So if you meet the test 2.5 times your average monthly payroll, or 2 million, whichever is smaller. Joe?
New first draw PPP loans look just like the original loan program.
Yep. So we've made some allusions to this already. These are for people who didn't get a loan during 2020. So you're late to the table, if you will. Maybe back then you had didn't feel like you needed the money, but here you are today, and you're behind the 8 ball, and you need to look at borrowing. For these loans, it's the exact same thing. We still have a 500 person head count threshold. So that means there's a little more availability here. The maximum loan amount is up to $10 million. So it's the lesser of 2.5 times your average monthly payroll and $10 million. You can actually use 2019 or 2020 payroll data for your average monthly payroll calc. So you have a choice there. You could use, by the way, for second draw PPP loans, you can also use 2020 average or payroll data, but you probably already have submitted your 2019, and that's probably the more favorable data anyway. So I can't imagine for second draw loans, there's going to be many people who are going to want to use their 2020 payroll data. And the same here. If you're probably going to find you had more people employed with higher payroll costs in 2019, and so your loan will be larger for most organizations if you're using your 2019 payroll data. And for these loans, there's no revenue reduction requirement.
Okay, number 8, religious organizations can draw comfort from Congress affirming free exercise regulation that SBA adopted on April 15, 2020. Tell us about that.
Yeah, so as I said earlier, the SBA was a little bit unsure what to do with these nonprofit organizations, particularly churches and other religious organizations. But ultimately, they issued some regulations that specifically acknowledged, among other things, that there was a free exercise of religion issue here if they were to prohibit churches from participating, and particularly when they had a statute that specifically allowed nonprofits and didn't make any exception for churches from that. So they came out with a fairly detailed analysis of why churches should be allowed to participate, and also why churches should be allowed to participate separate from their affiliated organizations. So, two churches that were from the same denomination in the same community didn't have to be viewed as a unity. They could be viewed as two separate entities for the purpose of applying for a loan. And so the Consolidated Appropriations Act that was passed in December had a specific provision in it that did 2 things. And I think we might have that on the next slide, Joe, and that is that it explicitly called out this notion that the SBA got it right in the regulation they issued earlier in the year. And then it got rid of an SBA regulation, didn't eliminate it from the books, but it said it was inapplicable for these PPP loans that prohibited the SBA from making loans to organizations principally engaged in teaching, instructing, counseling, or indoctrinating religion or religious beliefs, whether in a religious or secular setting. So that's a standard prohibition in general SBA lending, but that particular prohibition was made inapplicable to PPP loans by this particular bill. So that's a win for churches and other religious organizations. Point number 7 we were going to make is that the CARES Act provision that required PPP loan forgiveness to be reduced by the amount of any EIDL advance, and EIDL stands for Economic Injury Disaster Loan Advance, was repealed retroactively. So some of you on today's webinar may have applied for and received an EIDL advance. And when you went to apply for your loan forgiveness, if you've already done so, you would have found that there would have been information in the instructions about your loan forgiveness amount being reduced by the amount of any EIDL advance. But Congress retroactively repealed that back to the enactment of the CARES Act, so back to March 27th. And the SBA has come out and said, well, if you've already submitted a forgiveness application and we've made a loan payoff amount to your lending organization, then you won't need to do anything. The SBA is going to go ahead and automatically identify that scenario, and they're going to make a payment to your lender to reduce your loan balance by the amount of this idle advance. And if that was the only thing that reduced your loan forgiveness amount, then you would get complete loan payoff at that point in time. And to the extent you've made loan payments because you had this unforgiven balance, then you would expect to get a refund. And that refund might even include some interest. So just be aware that if this is a situation you found yourself in, then you should get a refund. So there was a CARES Act provision that prohibited claiming of the employee retention credit if an organization received a PPP loan, and that has now been retroactively repealed back to March 27th, as though this prohibition never existed. So what that effectively means is a couple of things. Number one, it means if you're seeking a loan today, whether it's a first draw loan or a second draw loan, and you're applying for that loan today, if you otherwise are eligible for the employee retention credit, then you can go ahead and apply for that credit. And you will not be denied it merely because you've either had a PPP loan in the past or are currently in the process of applying one. The two are now totally divorced from one another. There's no interaction between the two with one exception, and that is any wages that you use to claim forgiveness for your PPP loan cannot also be submitted for purposes of the employee retention credit. So your covered period for forgivable loan expenses won't begin until your loan is dispersed. So if you haven't received your second draw loan yet, you can certainly be looking back to January 1 of this year up until the date your loan is dispersed. And those are going to be definitely qualifying payroll expenses. And then as you go through the process of accumulating your forgivable expenses, at some point in time, you're going to max that out. And then you would be able to pick up employee wages that occur after that. Although this, the employee retention credit, I believe, is set to expire. I don't have the date firmly in mind, but I believe it's sometime at the end of June of this year, perhaps. It's in that neighborhood. So it doesn't have an indefinite ending, but it does have an ending. All right. The PPP loan forgiveness covered period is now flexible within some boundaries. And what that means is before, the original CARES Act period was 8 weeks, and then the PPP Flexibility Act came out in June of 2020, and it gave us a 24-week period. So it extended the 8 weeks to 24 weeks, and people who had gotten their loan before June 5th of 2020 were told they could pick between 8 weeks and 24 weeks by rule. And then the SBA came out and said, well, we'll allow you to apply before the 24th week, but you're going to have to continue to use 24 weeks for certain purposes within the calculations of the loan forgiveness application. What the Consolidated Appropriations Act now has said is you can pick any date. You as the borrower can pick any date between the end of the 8th week and the end of the 24th week. So if you want to be at 10 weeks or 11 weeks or 12 weeks or 13 weeks, if that's all it took you to accumulate enough payroll costs or payroll and other related forgivable costs, you can have a shorter period. It remains to be seen how some of that's going to work its way out into the 2021 loan forgiveness applications. They have revised the loan forgiveness applications and covered some of these points, but they have not covered all of them. But the other thing to note is, as I say on here, it covers both first draw and second draw loans, and including loans that were issued in 2020. So if you got one of those loans back in 2020 and are just now getting ready to accumulate your cost and submit your loan forgiveness application, you have this same flexibility around selecting the ending point of your covered period. So payroll costs now include group life, dental, vision, and disability insurance. And I put this in here for this specific reason. In the original CARES Act, you can see here on the screen, this was a list of things that were included on the face of the act. And then the SBA had to come along and clarify some inartfully drafted provisions, but they only included group health insurance in the original wording of the act. The SBA later came back and in an FAQ told us that we could take dental and vision insurance, but we were not yet allowed to claim life insurance. We thought we could claim disability because it was perhaps health related. They've now clarified group life and disability are now in by statute, and dental and vision are now in, not as by SBA rule, but by statute. And these post-date back to the original enactment of the CARES Act. So this would be if you haven't yet filed your loan forgiveness application for last year and you want to come back in, you can do that. So Joe, we've kind of continued on without you in the interest of time. Latrice stepped in like a champ, and we've kind of continued on here.
Excellent.
So the other thing I wanted to say here, a couple people have asked about some other types of things that look like payroll, like workers' compensation. We don't have any information that would suggest definitively that workers' compensation would apply. And I would tell you that with the flexibility now to go to 24 weeks and their ability to claim some of these other types of expenses, I don't foresee any issue at all meeting the forgiveness thresholds without reaching for things like workers' comp. And so I would probably suggest to you that you not worry about that. On the slide here, you see I talked about minister's housing allowance. That was unclear at the beginning. It's now clear minister's housing allowance is includable. You will see in some of the provisions or some of the guidance that's published on the SBA's website that they talk about pulling your loan cost or your payroll costs from your Form 941s, and they specifically direct you to line 5C on the Form 941, which covers Medicare wages. And one of the challenges for that for churches is that your pastor's minister's housing allowance is not included in line 5C, nor is your pastor's salary included in line 5C. And so you're going to find you're going to need to augment that line 5C amount with the amount of your minister's housing allowance and the amount of your minister's salary. And this includes not only a senior minister, this includes anyone on your ministerial staff, whether that's an associate minister or anyone that you're treating as a minister for payroll purposes, you're going to put them on here. And this leads to one other point I know we've got in the question list, and that is, are ministers self-employed? And for this purpose, ministers are not self-employed unless you deem them to be independent contractors receiving a 1099. If you're issuing them a W-2, which would be the normal 99% case, even though they are paying self-employment tax, they are still deemed an employee for this purpose. And so that's the reason why I'm suggesting to you or telling you that when you do go to the 941 and pull that line 5C amount, you're going to need to add to that your minister's housing allowance, your minister's salary, and if you happen to make them whole for self-employment tax purposes by giving them some amount to account for the fact that you're not paying an employer's share of FICA and you're giving them an additional, what I might term a SECA, Self-Employment Contribution Act allowance, that technically is just salary to them. That might be how you budget it and how you think of it for your churches and kind of internal understanding of why you're paying them this additional amount. But that's a box one includable amount in their W-2 that's really just salary and wages from the IRS's perspective. I can't remember if I had one more slide on this number 4 or not. Nope. All right, moving on to number 3. So in addition to payroll costs, mortgage interest, rent, and utilities and forgivable expenses now include a whole new category of items. And this is retroactive all the way back to March 27th. As long as you haven't submitted a loan application and gotten a forgiveness disbursement to your lender, you can, up to and including maybe going back and amending a loan forgiveness application if it hasn't yet been processed, claim a whole new category of expenses. These are called covered operations expenditures, covered property damage cost, covered supplier cost. All of these terms have meanings. I think for now, in the interest of time, I'm not going to try and define them for you beyond what you see here. But they basically are a whole new category of costs that they're described in the loan forgiveness application, and they're also described in the various guidance that is referenced in the articles that Joe pointed you to at the beginning. So Joe, let's move on. So for PPP loans, 50,000 or less, and I don't know how many of our folks on the call today might meet this definition with their 2020 loans, or might meet that with new loans. Borrowers are no longer required to reduce their loan forgiveness amount for reductions in full-time employee headcount or salary wage reduction. So this is a big benefit because it reduces the burden of doing these calculations. Now we might say, well, people who are borrowing, since it's based on payroll costs, since the loan amount is based on payroll cost, these amount, they would not have all that many employees. But basically what this is saying is, if you are in this category, you're going to have very little documentation you have to provide. You don't need to do any of the FTE calculations. You don't need to do any of the calculations where you have to look at whether you reduced people's pay, their rate of pay by any dollar amount. So this is a big simplification. And let's go on to the next slide, where we're going to see that we're going to use Loan Forgiveness Application Form 3508S. This is the simplified version of that particular loan forgiveness application for this purpose. And then let's go on to our final point. For PPP loans of 150,000 or less, loan forgiveness is actually a little more streamlined. And if we'll go one more slide, we'll see it's streamlined in a number of different ways. You still use Form 3508S, but that form is now only one page long. And most of the page is made up of a bunch of statements that you have to certify that the statements apply to you. So you're supplying very little information on the form if this applies to you. So if you haven't, there's actually a rule here that if you've already submitted one of the original loan forgiveness applications that hasn't yet been processed, there are some guidelines about how you can replace that with this more simplified one-page form. You have a reduced obligation for record retention, numbers that support your employment, your opportunity for employment, or that document the fact you didn't have any reductions in employment and those kind of things. You're required to keep those for 4 years instead of 6, and other relevant records for your PPP loan application, like mortgage interest and rents and utilities costs, you're only required to keep for 3 years. If you're 150,000 or less. For everybody else, you have to keep them for 6 years. You have to keep all that data for 6 years. All right, so that brings us back to the end. And I think, Joe, this is where we'll deal with questions. So I've got the Q&A list here, and I'm going to go up to the top. As Joe suggested, we've had a lot of folks hitting that thumbs up button. I've kind of addressed already. Deborah Sexton asked us early on in the presentation what to do about restricted or designated givings, and I've already kind of told you that we right now don't have a good answer to that. And if that's the thing that's keeping you from being eligible or from meeting the revenue reduction rule, then I have one suggestion I might have for you is that you reach out to your lender and see if they can call the SBA helpline for this, and see if they can use that as a manner of getting some guidance. I don't know that I talked about the revenue reduction rule as much as I had intended to in the earlier part of the presentation. So let me take a few minutes to talk about that for a minute. If you were in existence for all of 2019, then there are 2 ways that you can meet the 25% reduction. One is that you can take your whole year and meet the reduction rule based on a full year set of data. You don't have to do the quarter by quarter. This is the SBA coming along and saying, we know that for some folks, quarterly information may not be readily available. If you've got annual information and we've got a full year to look at between 2019 and 2020, then you can use the full year to make this revenue reduction test. But for everyone else, if you were in existence for all of 2019, then you're going to pick one quarter, and it has to be a calendar quarter. Some folks have asked, can we use 3 continuous months that are other than a calendar quarter? And the answer to that is no. You must use a calendar quarter. And for those of you who use a fiscal year that doesn't neatly cause quarterly financial statements to be produced on calendar quarter intervals, that's going to create a burden for you. But that's the current state of the rule, is it has to be a calendar quarter, and it's looking at quarter over quarter. So we're going to compare the first quarter of 2020, first calendar quarter of 2020 to the first calendar quarter of 2019, and the second calendar quarter of 2020 to the second calendar quarter of 2019, and so forth. And if any one of those quarters has a 25% or greater revenue reduction, and again, we talked about how revenue is calculated. It's a gross receipts calculation. Then if you're using cash basis, then we're not going to worry about things like pledges. If you're using accrual basis, then you're going to have to worry about things like pledges that you are required to accrue under GAAP accounting rules. And we only need one of those quarters to show a reduction. If for some reason you're an organization that was not in existence in all of 2019, then there is a set of rules. I won't go through them. I don't have them memorized, and they're a little more complicated, but we can certainly talk you through them if needed. That tells you which quarters in 2020 you're supposed to compare to 2019, and how you make the math work when you don't have when you were not in existence for the full year of 2019. Another common question here, got a lot of thumbs up, was when we're doing this calculation, this revenue reduction calculation, what do we do with our first PPP loan? Well, first off, that first PPP loan is not gross receipts until it's forgiven. So it shows up, when you get a PPP loan, the way you book that on your accounting records is debit cash, credit loan payable to the SBA. And then as that loan is forgiven, then you're going to take the loan off of the books by debiting loans payable and crediting typically grant revenue, and it's governmental grant revenue. And there are two competing schools of thought that have emerged in the timing of this. One school of thought that's based on GAAP for contingent grants or contingent contributions that require you meet certain barriers before the grant becomes something other than a loan. Those folks say, well, as soon as you've incurred forgivable expenses, that the only thing you have left to do is apply for forgiveness, but you've actually accumulated you've met all the requirements in terms of having forgivable expenses, that you're going to record those as contribution revenue at the fiscal year end when you've met those barriers. The other competing school is that you don't book that as contribution revenue until you actually have the piece of paper in hand from your lender that says the loan has been paid off in full by the SBA. But regardless, your PPP loan is not includable in revenue under whichever theory you're dealing with here. It is not includable in revenue until such time, or it's not includable in revenue at all. So if you've included it in revenue for financial statement purposes, that is a permissible reduction and reconciling item in making this calculation. You'll just need to document that in your calculations and in your documentation, and be prepared to demonstrate that to the SBA if they ask the question. And your lender, for those of you who are borrowing more than $150,000 in particular, your lender's likely to ask you to have that as part of your, called out specifically in your documentation. So this person is asking, Bill Sanders is asking, I saw something about submitting tax returns to show income that your income was off 25%. What about churches that don't file tax returns? So your tax returns are not a required approach to this. They are a permissible approach. So churches are going to use internal financial statements, audited financial statements, whatever you have that lines up with the proper time periods is what you're going to end up using. And there's nothing that says right now, for example, that for showing the quarterly reduction, that you would need to have your audit firm come in and audit that particular quarter, that they'll only accept audited answers. We don't have that is not the rule. Right now, it basically just says you could use internal financial statements. Now you'd want to make sure you've done those well, and that you don't that you accounted for everything. And if you're a little bit loosey-goosey in your normal quarterly accounting and you don't mind too much that things might slop between quarters, I'd probably want to be a little more rigid or a little more concerned about that in this environment, and make sure I've got good cutoffs between quarters. I know that for some folks, close enough is good enough for most of the time. This is one of those times when I would suggest to you, close enough is not good enough. You want to be a little more exact if you're using that information for this purpose.
Ed, one of the questions I hear often is about the NACS code for churches that's on the application on the second round. Have you addressed that question yet?
Yeah, I have not, but I can real quick. So the NAICS code for churches, I have it written down here, is 813110. 813110. And why that's important is because certain organizations whose NAICS code starts with 72, they're typically going to be hotels and restaurants. They get a whole section of the PPP loan program that's specifically called out for them. And that's one of the reasons why this question is being asked for on the loan application and the loan forgiveness application. Let me make one other observation here, because I did have a kind of a related question from a client in Florida. And that is, if you're an organization that happens to operate another activity within your church, so maybe you have a daycare center, or maybe you have a coffee shop, or maybe you have some other form of activity that you do, and you account for them separately. You have a separate department in your general ledger, maybe even have a separate general ledger for them, but they still are operating under your corporate identity. They use, even if they have their own EIN, if they're not separately incorporated from you, they're part of your identity, then they cannot themselves apply for a PPP loan separate from you. You would have to use their activity plus the whole church's activity to get to that conclusion. There is a limited exception to that for radio stations that are operated by public universities, but I'm guessing that doesn't describe anybody on the call today. I wanted to look at a couple of other questions. There are some more questions I'll get to in a minute, but there were a couple of others that here. If one of the real questions that came out at the time of the original PPP loan process was a very confusing provision in the statute in the CARES Act that the SBA ultimately came back and essentially rewrote and said, Congress didn't get it right. Here's what the rules should be. And this had to do with, what do we do about FICA and Medicare taxes, that we have an employee portion and we have an employer portion? What do we do about federal income tax withholdings and those kind of things? And they said, basically, the employee piece of that you ignore, because we're going to use the employee's gross pay, right? And to arrive at the employee's net pay, we take those things out. But we're going to start with the employee's gross pay. And that is part of your payroll cost, the employee's gross pay. What's not includable in your payroll cost is the employer's portion of FICA and Medicare. So if you have, your pastor, you're not paying FICA and Medicare tax for, but for your other non-pastoral staff, non-ministerial staff, you are paying FICA and Medicare an employer share, and then they're having an amount withheld from their paycheck. Well, the employee share we don't care about because we're starting with their gross paycheck, but the employer share we do not get to include in payroll cost. Again, let me say it again, we do not get to include the employer share of FICA and Medicare in payroll tax. If any of you are participating in a state unemployment insurance program by paying unemployment insurance, not as a reimbursing employer, but if you're paying unemployment insurance, that portion is includable in payroll cost if you're doing that. Retirement plans, so if you got 403B plans or things like that where you're paying a retirement amount for a pastor or non-ministerial staff, those are also all includable in your payroll cost. Joe, did you want to ask me one of the other questions that you've got on your list?
I get questions about staff reductions. If an organization has had a staff reduction in 2020, but they're using 2019 data to calculate for the loan, what are the implications of that?
So right now, you're permitted to use either 2019 or 2020 payroll data to figure your loan amount. So if you meet for example, for a second draw loan, if you meet the 25% gross receipts reduction test, and if you are under 300 employees, so you're otherwise meet these qualifying requirements, there's nothing in the rules right now that says you have to pick the smaller of the 2 years or the year that most closely aligns with your current payroll size. They say your discretion, pick 2019 or 2020. And so there may be some folks who feel awkward about that, who would prefer to use 2020 because they feel that's a more honest answer. I would tell you, I would say there's no moral judgment to be made here. The way the guidance has been written, there's no moral judgment to be made between picking 2019 and 2020. If you feel, what I tell people about a lot of these things with churches, because there's a lot of folks in church boards and other organizations who are really seeking the Spirit's leading on these kind of questions. And I certainly don't want to get in the middle of a genuine, reflective discussion where the Holy Spirit is leading a group to make a particular choice or a particular decision. So be mindful of that. Be aware that you're approaching these things prayerfully, and you know, we're allowing God to give us some leading on this through His Holy Spirit. But outside of that kind of scenario, I don't see a reason why you would choose one over the other if one of them gave you a higher loan amount.
You've still got to be able to use it for qualifying expenses. That would be the challenge. You might not be able to use it all.
Well, and if you had a significant reduction, that might be the case. But with a 24-week covered period in order to cover those payroll costs, and we're only looking at about 10 weeks of payroll cost, you probably, unless you just had a really drastic staff reduction, you'd be able to meet that in 24 weeks.
Ted, can you speak into the likelihood that these funds are going to run out? Do you have any sense of that?
So the kind of thing I've been seeing in the press is that the narrowing of the second draw loans and the number of folks who got a first draw loan, meaning that there'll be few people applying for a new first draw loan now, that there's not a real strong expectation that the program is going to run out of money this time. Now, time will tell. And it's early days yet. They've only been receiving applications for a couple of weeks now. So it's early days, but I don't know that you have to be rushing out. You know, back in April of last year, everybody was trying to be the first one in the door because we had no idea how quickly the money was going to last. And in fact, it did run out in the first go round. Now the June allocation of money did not run out. It got down to a few tens of millions of dollars left. So it was close, but it did not run out of money. And so there's an expectation this one won't either.
It's also what I'm hearing. I was a CEO of a bank before feeling a call to ministry and coming to Horizons. I've got a son who's a chief credit officer at a large community bank. And the way the money's being drawn down right now, everything that I'm hearing from bankers is they're not expecting this to run out because they're so they've been restricted both in the size of the loan and who qualifies for it.
Yeah, I think there's, you know, again, time will tell, but I don't, there's not the rush to get in the door this time there was the last time. And with the 300 employee headcount, and there's also been a strong move to make sure that certain industries and certain minority groups and others are having a fighting chance at getting in there. I think there's a strong feeling that some particular industries and some particular groups were underserved by the last round. And so I don't know that necessarily means people are being, there's any reverse discrimination going here. I'm not trying to imply that. What I'm simply saying is that from a availability standpoint, there's a concerted effort to make sure there's more people available, or it's available to more people. And that might make a little more pressure on it, but that, again, time will tell. I did get a question here about if we have 24 weeks and in our given situation, our payroll costs are going to be equal to our loan amount, do we really need to go pull in mortgage interest or rent or utilities costs? And my answer to that is no, you don't. There's no requirement in any of the rules or regulations or in the loan application itself that you have to use stuff other than payroll, or have to include things other than payroll cost on your forgiveness application. So if you can meet forgiveness with only payroll costs within the 24-week or an 18-week or a 14-week period, I have no reason to tell you not to do that. I suppose there might be somebody out there who would make the argument that it just looks a little better if you have a more balanced application that has something on every line. But I don't know that I would view that as that I have a strong inclination that you should go that route in that case. I think we had somebody else on the questions here ask, we don't have a lot of employees. Would we be eligible for a loan? And the answer is, if you have 0 employees, you can't get a loan because you have to have pay, or you can't get a loan because the loan has to be described in terms of payroll costs. So if you don't have any payroll in order to define a loan amount, then you couldn't get a loan because you don't have payroll. Uh, if you only have one or two employees, then and you have a lot of volunteers, or you have one or two employees and everybody else is an independent contractor. Independent contractors can go with their own PPP loan. They're not includable on a church's, for example, PPP loan application. And so your size of your loan would be small. You'd be eligible for a loan perhaps, but the size of your loan would be small.
So there's a question about not having heard from their banker on their PPP forgiveness. My encouragement is just to contact your banker and ask where that is in the process. Banks generally held up on forgiving those loans because they wanted to see this act passed and see what was going to be different about it, but they're really running them through right now. So I would check and see. Ted, have you asked about, or if you answered the question about endowment income, does that calculate in the 25% reduction?
So I'm going to take this in two ways. Number one, if you have contributions into your endowment, that would fit into the whole kind of restricted giving part of our question, where we said we don't really have guidance on whether or not you could exclude those contributions from your account or your calculation or not. But if we're talking about either spend policy draws on your endowment policy, so if you have a spending policy that says we're going to take the interest and dividend income off the endowment and move that over to operations, those amounts would be includable in your gross revenues. I could not imagine a scenario in which those kinds of dollars would be excludable.
Ted, two more questions, and then we're going to thank you for being a part of this. The first is an interesting question about a church that has a preschool. The church, the combined entity, doesn't qualify because there wasn't enough of a reduction, but the preschool itself qualified. They have the same EIN number. Can that preschool apply, or must it have a different EIN number to do that?
It's not just a different EIN number. It would need to be a separate legal entity as well. I do know of some examples where preschools operated by churches have a separate EIN, even though they're not a different legal entity. But they would need to be two separate. They have to be two separate legal entities so that the preschool is able to stand on its own as a borrower. And so the church would be the real borrower in that case at the end of the day, right? And it's the owner of the preschool, the operator of the preschool. So no, unfortunately.
Ted, last question. And this was what I was asking when the power shut off the first time for me here.
Okay.
And that has to do with the clarification where Congress said to the SBA that churches do qualify for this. I have spoken with a number of churches who have chosen not to apply for a PPP loan because they are afraid that the government is going to come back and take away some of their religious freedoms based on having taken money in the past. You are both an attorney, and a CPA, and you're involved in lobbying and questioning efforts through your accounting organizations. Do you have any wisdom in regard to that fear? Not whether we should take the loan or not, but is there any fear of loss of religious freedom based on what you can see?
We don't know the future, so there is some sense in which we don't know what we don't yet know because the future hasn't happened yet. My expectation is that accepting this money now, having it forgiven and kind of being a completed transaction on both sides of that would mean it'd be highly unlikely that this would be opening the door for future government intrusion. Were we to have a situation where you're an organization that has not yet applied for forgiveness and something happens in June of this year and you apply that would change the dynamic and you apply for forgiveness in August, could that be a scenario that would make you ripe or a target for government intrusion? I think that's a remote possibility on the basis that I don't think the courts would allow for that, but we don't know the answer to that, right, until it's tested and so forth. I'm in a position of where my wife is the financial uh, accountant for our church. She's the one. Our church did choose to obtain a PPP loan application. I was invited to address our church board, have a conversation about these kinds of matters, and I didn't really have any hesitancy at all about suggesting to them that our church would move forward on that. But I understand that there are others who might have a different comfort level with this, and I can't assume your risk on my shoulders. So I understand that that there might be folks out there who are more risk averse than that, and I certainly wouldn't suggest to them that they're being fools or being foolish by choosing to do that path. If you're not in an existential crisis situation where not borrowing this money is the difference between keeping your doors open or not keeping your doors open, and you're taking that position, then it would certainly be understandable that you would want to take that position.
Well, Ted, thank you so much for being with us. I want to remind everybody that you're going to get this recording. You're going to get the slides. You're going to get the links to the 2 resource documents that Ted has already created that really this presentation is built upon. And if you want a deeper dive, really to go through it, we're going to show you how you can participate in that webinar on February the 17th at, I believe, 1 p.m. Eastern. Is that correct?
Yes, February 17th, 1 p.m. Eastern.
So thank you. Any closing remarks to our listeners today before we go?
Well, I appreciate everyone's attention, and clearly from the questions, the volume of questions and the nature of the questions that came in, this is still a topic of great interest to people. Thank you for joining us today. Thank you for your participation, and thank you for the very good questions. So we had an opportunity to hopefully tailor this to our audience's needs.
Thank everybody for participating. You'll have resources coming your way. You want to continue to get more information, you'll be able to do that as Ted and other vetted resources create information. You will know that Horizons is posting the latest of that on our website and also on Giving 365. So you can always go there to catch up with the latest and the greatest. Everyone, thank you very much for participating.